Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri, and thank you for tuning in. This week, as usual, we'll discuss our 4 key points highlighting learnings from the market activities from the past week. In point 1, we'll do a market recap with our key market indicators. In point number 2, we'll look at consumer confidence. In point number 3, we'll look at the gross domestic product or the recently released GDP data. And in point number 4, we'll take a look at the personal consumption expenditures, which is the Fed's preferred gauge on inflation. Now, on to point number 1, the market recap. First, each week we look at the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a healthy 2.5% growth, and we'll dive into the detail of the actual data that was released for Q2 in point number 3. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of the labor market. This week, initial claims came in at 231,000, a 0.8% decrease from last week, and continuing claims maintained at 1.863 million. Next, for 2024, we're watching mortgage rates closely to see how home affordability is trending. This week's rates remain relatively the same, with the 30-year and 15-year ending at 6.46% and 5.62% respectively, with only a minimal decrease of 0.03 and 0.04% respectively compared to the last week. Next, we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread falling slightly from 27.96% last week to 24.19%. This is a drop of 3.66% from last week, but is significantly higher than the long-term average of 6.68%. Next, we will continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is showing an increased probability of a 50 basis point rate cut as compared to last week, with a 69% probability of a 25 basis point decrease and a 31% probability of a 50 basis point decrease in September. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended positive 0.59%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 0.02%, essentially flat. And the MSCI EFA, which tracks international stocks of developed countries across the globe, excluding the US, was positive 0.61%. We have a new leader in the mix again. International stocks took the win. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the market is performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. And on to point number 2, consumer confidence. Consumer confidence in the U.S. economy reached a 6-month high in August of 2024, according to a report from the Conference Board. This increase in confidence was attributed to improved perceptions of the current and future business conditions. Consumer confidence index rose to 103.3 in August, up from 101.9 in July, marking the highest level since February. Despite the overall optimism, concerns about the labor market tampered consumer confidence. Although consumers remained positive for the current labor situation, their assessments continued to weaken, with fewer consumers viewing jobs as plentiful compared to the previous month. This apprehension is stemmed from the recent rise in the unemployment rate, which reached 4.3% in August. Furthermore, consumers expressed more pessimism about income growth in the upcoming months. The report also highlighted a decline in consumer spending intentions, particularly for big-ticket items like homes, motor vehicles, and major household appliances. This decline in housing affordability, driven by high mortgage rates and home prices, contributed to the lowest level of home buying intentions since 2013. While some relief in the housing market might be on the horizon due to an increase in the housing supply and the Fed rate cut, the immediate and long-term impact is debatable. And on to point number 3, GDP. The U.S. Bureau of Economic Analysis's second estimate for the second quarter of 2024 shows that real GDP increased at an annual rate of 3%, a significant upward revision from the 2.8% reported in the advance estimate. This acceleration in GDP from the first quarter's 1.4% growth was primarily driven by an acceleration in consumer spending, a key driver of economic growth. However, this positive revision was partially offset by downward revisions in several other areas, including non-residential fixed investment, exports, private inventory investment, and government spending at both the federal and state levels. This suggests a more complex economic picture than initially portrayed, with potential softening in business investments and international trade. Despite the upward revision of GDP and the consumer spending, the report also revealed some potential areas of concern. Personal savings rates saw a downward revision to 3.3% in the second quarter. This, coupled with the previously discussed concerns about the labor market, such as the rise in the unemployment rate and weakening consumer sentiment towards job availability, might point towards a more cautious consumer outlook in the near future. The decline in personal savings is an important metric to watch. As savings rates decrease, spending also tends to follow. Thus, as shown on your screen, this could impact future GDP values as personal consumption is consistently greater than 60% of GDP. And on to point number 4, inflation. The Federal Reserve Preferred Inflation Gauge, the Personal Consumption Expenditures Index, showed that inflation remained steady at 2.5% in July of 2024. While this indicates progress in slowing inflation, it still sits above the Federal Reserve's target of 2%. Despite this, the latest inflation data is being viewed as encouraging, with some calling it a bright green light for the Federal Reserve to start cutting interest rates. The core PCE index, which excludes volatile food and energy prices, also remains steady at 2.6%. This figure, along with the overall PCE index holding steady, was better than the market expected. Now, several factors contributed to the July inflation figures. Consumer spending increased by 0.5%, driven by strong sales at car dealerships and Amazon's Prime Day sales event. Additionally, personal income increased by 0.3% in July, primarily due to an increase in compensation. However, spending growth outpaced income growth, leading to a decrease in personal savings rate, as we discussed in point number 3. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners all across our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click in the link in the description below to schedule a meeting. Thank you for watching. We look forward to seeing you next week.